The chase for yield has been a major theme of the local market for the past few years, but can it be sustained? Dividends from Australia's top 200 companies have soared 64% in the past 5 years as companies do their best to satisfy investors' demand for income. But economists and fund managers warn that the dividend fetish may be leaving company coffers bare, hampering future growth. Neil Woolrich reports.
It's an economy in transition, and as the mining boom fades, businesses are still unsure where the next growth spurt will come from.
Yes, activity is slightly better, but they're still feeling a bit nervous, and so they're very reluctant to employ and invest.
The demand from our customers is good at the moment and strong. Everything's pointing in the right direction. It's just a few tough years and it's not confidence around a lot.
A survey released by the Bureau of Statistics last week shows that firms are planning to spend 25% less on major investments next financial year than they will this year, to levels that some economists are describing as recessionary. In part, it's because big-ticket investments are seen as too risky in this low-growth environment. But listed companies are also under pressure from shareholders to keep their dividends up as investors chase high-yielding stocks.
It definitely has developed the mentality that we need to give the investors what they want, and my suspicions are that they've gone too far and haven't left themselves any room in terms of, if there are investment opportunities, that they have room to move in terms of retained earnings.
The total amount of dividends paid by the ASX top 200 companies has grown from $38 billion in 2010 to $62 billion this financial year, a 64% increase over 5 years. While that may be helping to keep share prices elevated for now, the downside is that a lack of reinvestment in business today could hamper growth prospects tomorrow.
What will tend to happen is the economy will tend to grow slower, particularly in the next couple of years in Australia, where you know that structurally half of the investment that's going on in the business sector is sort of shrinking big time in the mining sector.
Fund manager Paul Moore says over the last 12 to 18 months there have been better investment opportunities offshore where stocks are cheaper and have a better earnings cycle ahead of them.
The banks are a classic example where they've maximised their payout ratios, and we think they went too far, and that was now fully factored into their prices. Whereas in offshore banks, they're really only entering that period where they're starting to raise their payout ratios.
In Melbourne's manufacturing heartland, Paul Hughes owns and runs his own business, so he doesn't have to worry about the demands of public shareholders. Still, he's cautious about making major investments right now, even though demand for his precision metal products is solid.
Advanced manufacturers like us are actually really alive and well out there. It's just getting that confidence back in the industry, building our war chest and recovering after, a tough period over the last 3 or 4 years.
Paul Hughes says with the economy fragile, government needs to help businesses like his make their next big purchase.
And I think if there was some sort of government assistance to help us there, then we might bring that decision forward so that we could start employing, a bigger team and developing the business further.
Alan Oster says NAB's own surveys are not nearly as bleak as the Bureau of Statistics numbers and are pointing to modest growth in business investment next financial year. But he agrees there's a role for the government and he'd like to see investment in infrastructure projects that can start right now.
Business is still almost in a liquidity trap. They're still nervous. They're not going to basically do much. And if you can get the economy running, get some extra sales as things flow through, then business can pick up the burden, if you like.
Whatever it takes to stop the economy getting stuck in a dividend-driven downward spiral.